Welcome in, everyone, to a brand new episode of the Real Estate Tax Playbook, where we discuss all things real estate, providing timely and precise information to real estate professionals looking to build their own customized tax planning playbook. As always, I'm your host, Evan Ross, a director with Brown Edwards & Company, based out of our Roanoke, Virginia office location. For those of you who have not had a chance to tune into the podcast or are tuning in for the first time, please go check out the Brown Edwards website at your convenience. As always, a link to that website can be found in the description of this podcast. On the website, you'll find more information on our other 11 office locations, as well as our other service lines outside of tax and details on some of our other service providers. With that, I'd like to introduce to you our guest for today, or welcome back, Pat Murtaugh, also with Brown Edwards & Company, based out of our Roanoke, Virginia office location. Pat, thanks for being here.
Yeah, appreciate you having me today. As Evan mentioned, I am a tax partner in our Roanoke, Virginia office. I do specialize in real estate, so happy to be part of the podcast again.
Definitely. Glad to have you back. And for those of you who don't know, Pat, you kind of actually gave me my first shot in public accounting about 10 years ago. So it's great to see where things have gone. And hey, now I'm hosting a halfway decent podcast on real estate. So
it's been that long already.
Yep. So hopefully I haven't let you down too much. But
Yeah.
anyways,
we're still kicking along okay.
Good deal. Yeah. Well, I appreciate you being here. For those of you that don't remember, Pat, he was on the intro video back at months ago at this point in time, back in, I believe, October of 2024. So, Pat, if you just kind of want to give a high-level overview, I know you did it back in the other video. You kind of gave a short intro just now, but kind of just provide some info on what you do for Brown Edwards, a little bit of your career path.
Yeah, absolutely. I have been in public accounting now for about 25 years. I'm as I said, a tax partner in the Roanoke office. So I do specialize, really a tax generalist, but with a high concentration in real estate, with a lot of real estate clientele, and particularly historic tax credits, which we'll talk a little bit about today. So
definitely. Great. Well, appreciate you giving that background on yourself. Obviously, you alluded to it. You probably haven't had a chance to listen to last month's episode, but we had Price Gutshaw with Tallheimer on the podcast. Obviously, he does a lot of commercial real estate. We brought up his wife, Katie Gutshaw, who I believe you know pretty well through the historic tax credit world. And we kind of had a brief conversation on the commercial side of some of those jobs. So I thought it was a good segue into this episode as well. So can you just kind of give us kind of say I'm looking at doing a historic tax project. Can you just give me the basics, kind of a high level overview of what that historic rehab credits look like?
Yeah, absolutely. There's probably a bunch of different ways we can go with this, but just a high level, the federal historic tax credit is a 20% tax credit against your income tax. It's administered by the National Park Service at the federal level, and many states also have their own credit. Virginia, today, as we're chatting, I'll probably be, pretty specific to Virginia, as that's where we spend most of our times, where we sit. But we do also work with other states' programs as well. But just to keep it basic today, when I do refer to the state credits, it will be, somewhat specific to Virginia. But many states do have a program that is similar, that is administered through each state's state historic preservation office. In Virginia, that's the Department of Historic Resources, or DHR. But the overarching program is administered by the National Park Service with the federal government. It is a three-part application process that, in Virginia is administered through DHR, and then the National Park Service sort of piggybacks off behind Virginia.
Very good. So you mentioned the application process. Do you mind kind of running through that, kind of step by step what that looks like, that timeline for someone investing in these projects?
Yeah, absolutely. Yeah, so it's a three part process. The first part is really a little bit of what we sometimes call the mother may I. Is it where's your building? If it's in a historic district, a registered historic district, it will qualify. If it's on the national landmarks, it will qualify. Or the part one, so the part one of the applications where you just would denote that. It's a simple one-page document where you say, hey, here I am, here's my building, I'm in this district, so I qualify. Or you have to apply for what's known as architectural significance, that you're a contributing structure within a community or within a town or city that may not be in an actual historic district, but it is a contributing structure. So that's the part one of the application where through DHR, they say, yep, we agree, you are a contributing historical building and you're good to go.
And where can you
Um,
find, so you've got a property, how can you determine before you even start that application process if you think your property is in one of those locations? Can you find that on the National Parks website or somewhere?
yeah, I would start with your local state websites just to see, or if we're sitting in Roanoke, Virginia. There is certain districts around Roanoke that are historic districts, and you could look around your local cities or towns to see that.
Okay.
Yeah.
Very good. So, and then moving on, I guess that's part one. So part two, I
Yeah.
guess you've determined that you've got a property that qualifies. And then part two, what does that look like?
Yeah. Part two is really where you document the current state of the building, photos, what the property, the history of the property. There's a narrative portion to it. And I will back up and say, depending on your individual expertise, I would recommend getting you mentioned, Katie, and she works with some of these, and historical architects that do this type of work, and can save you a lot of headache, because there are some pitfalls on just how this is described, what you can do, what you're not allowed to do. This very specific, architectural steps that need to be taken. Certain walls can't be removed, certain windows can't be, there's just the actual architectural piece that's very different from our accounting side of the fence. So I do recommend getting an architectural professional engaged, particularly for this part, the part two, where you're basically saying, this is what the property looks like, here's the history of the property, and most importantly, this is what we intend to do. The plan of rehabilitation, so to speak, and presenting all that. That's what the part two of the application is. So you want to make sure you're staying within the rules of the program.
Very good. Well, shout out to Katie. I still haven't had a chance to meet her yet in person. Obviously, I hear her name a lot through Price, through you and others. So maybe we need to get her on the podcast at some point in time.
Yeah, going through this program would be a good idea. Absolutely.
Yeah, definitely. So, okay, so we've kind of established, hey, the property qualifies. We've determined, hey, here's pictures of what we have. Here's the historic components. Here's what we're going to do. What's the next part? Part three look like?
Yeah, then there's the construction, everything you're doing. So even before you get to the part three is all the work. This is the hard part. And where we come in, as accountants on this is really the cost certification, what we call the qualified rehabilitation expenditures, commonly referred to as QREs in the industry. Qualified rehabilitation expenditures have to be audited, to show what was actually spent. So from the what counts standpoint for qualifying for tax credits is really more of your brick and mortar type costs and some soft costs. So, a lot of times, if you want to think about it simply, if you are rehabbing a building, and you took that building and turned it upside down, took the roof off and turned it upside down, kind of like what doesn't fall out probably counts. So there's no appliances, no furnishings, things of that nature don't count. We're talking about the building, the electrical, the plumbing, the roof, the facade, the brick and mortar, so to speak. you can count, reasonable architecture, engineering fees, and some reasonable developer fees as well, those types of soft costs. But items like the parking lot, landscaping, any kind of site work, any kinds of additions to the building, those are types of things that are all covered in that part two that maybe would or would not count.
Very good. And then once you get that, I gotta assume once you get all that approved, once you get part 3 approved, that's where the tax implications really come in to play.
Yeah, so once you're done with that and we've undertaken the construction, it's complete, you've received a certificate of occupancy, or the project is substantially complete. At that point is when we would cut off, do our cost certification, which is it's a special purpose, single purpose audit of just that project. We come in looking at invoices and proof of payment, review the application itself to make sure we're not counting things that might have been as part of an addition, or we're not counting expenses that are outside the footprint of the building, and that's where we do our certification. But yeah, so that's the part 3 where the architects will come back in, take pictures of the final product, showing everything that was done to show that everything was completed as was laid out in the part 2, and that the project is finished and complete. And our cost certification audit goes with that part 3. It takes a few months for DHR to go through and make sure you did what you said you were going to do. They review our cost cert, and then typically, they'll issue a letter, saying, here's the amount of your qualified rehabilitation expenditures.
Great. And have you found that there's obviously every project's different. Is there like a range of a timeline when these projects usually get started to when they actually get that part 3 approval, or does it really vary?
Very significantly, depending on the project. So, and one thing too, I didn't mention earlier, in Virginia in particular, to qualify at the federal level, these have to be income producing properties. So a rental property of some type, or a commercial building that maybe is being used in your own business. But in Virginia, you can also qualify for your personal residence and residence period. So it could be income producing or your personal residence in Virginia.
That's a great point to make. And somehow that was, you kind of alluded to it, but kind of what I was going to ask. Can this be commercial? Can this be residential? Can it be a mix?
It can be, yeah. So for the federal, it has to be income producing.
Mm-hmm.
And in Virginia, it can be both. In Virginia, it could qualify for both.
Very good.
For both of these, federal and Virginia, there are minimum thresholds as well on the amount of money that does need to be spent. Okay. So on the federal level is what's known as a substantial rehabilitation test. Simply put, you have to spend more than your adjusted basis in the building. So if this is a brand new building that not brand new, but new to you, a building that you just recently purchased, whatever your basis in the building, not counting the land, but that would be your hurdle. So you bought $1 million building, you would need to spend at least $1 million on $1 million of those QREs in order to meet the minimum spend test. And to your question, really on the timeline, there is a timeline on the spend. So on a single phased project, there is 24 months. So you'd have to spend more than that adjusted basis within 24 months. And on that part 2 of the application, you do denote whether you have a single phase project or a phased project. In the case of a phased project, you have 60 months to spend over that threshold. And in Virginia, it's a similar test. However, it's not off of your basis, but it's off of assessed values. So in Virginia, you have to spend more than 50% of the assessed value for a income producing property or commercial property. In the case of a personal residence, it's more than 25% of the assessed value. And again, excluding land, just the building, the improvements.
Wow.
So there is that timeline there on when the spend has to occur, but they're really all over the place on how long one will take.
Yeah. Well, yeah, and obviously a bigger project's probably going to take a little bit longer than especially if you're just doing your own house or your primary residence. If you're taking advantage on that case, then might be a lot quicker than a large 50 unit apartment
Yeah,
complex or something like that. So
we have seen a lot of, personal residents though that do take a lot of time. When
okay,
it's a house that you're actually living in, you might be doing just one room at a time or different things like that. So a lot of times those do get phased so that you do have more time to get that work completed and still meet the test.
okay, yeah. Thanks for pointing that out. That's I'm sure that's useful to a lot of listeners out there. Moving right along, I guess to who's claiming these credits. Is it typically the person that buys the property, the group of investors? What does that look like?
Could be both. A lot. So the credits themselves, if you're Virginia, the credit's pretty easily used. You have an income tax liability in Virginia, you can use the credit against it. Be it a corporate tax, an individual tax, you can use that credit against the income tax. It is not, you're not able to carry it back. It will carry forward for 10 years and it's not refundable. So you have to use it against an income tax. So Virginia, the credit is pretty easy to use. On the federal side, so typically the credit will be awarded to whoever undertook the renovation. So oftentimes it's done, in a typical real estate LLC will do the rehabilitation. That would be the applicant, that would be the LLC that's on the name of the part two and the part three that we discussed. All those costs would be capitalized on the books of that LLC, and they're awarded those credits there at that LLC level. Doesn't have to be an LLC. It could be in somebody's personal name on the personal tax return, but most of the time it's going to be in an LLC that would be awarded those credits. So if you and I were doing a building together, when we're 50-50 partners, the federal tax credits would be allocated to us 50-50. The federal tax credit has to be allocated in proportion to ownership. The Virginia credit can be allocated in any manner you see fit. However, there was a case a number of years ago now, more than 10 years ago now, that did say if the credits are not allocated in proportion to ownership, you most likely have a disguised sale of the credits. So
Have you
backing up.
ever ran into that issue with Virginia?
Oh, absolutely.
Yeah.
Yep. So just to close the loop there on the federal side, what would normally happen, I said that Virginia credits are pretty easy. So if you and I, again, we're in that 50-50 partnership and we each get half the federal credits and we each get half the Virginia credits, you and I each having a Virginia income tax liability, we could use those credits fairly easily against our Virginia income tax. The federal credit, however, is not so easy to use. Certain taxpayers can use it pretty freely, but others cannot. You and I as CPAs, as our day jobs, not real estate professionals, not a whole lot of passive income, we're not going to be able to use those credits.
Yeah.
So they'll carry forward, and the federal credit, you actually can carry back 1 year and carry forward 20 years. However, the chances of us using them are very slim. So that's when we would want to consider possibly bringing in some investors.
Yep. So in that example, I mean, obviously, so we mentioned that due to the passive activity rules, we're probably not going to be able to utilize those federal credits. What does that process look like if I'm trying to find someone to, can you purchase these, transfer these credits? How does that work? How would you find someone that's interested in acquiring these credits and utilizing them?
Yeah, there are many groups that do offer tax credit syndication services and set up syndicated partnerships that will bring investor members into an entity to be allocated the credits. That does get fairly complicated, on the structure. So again, you want to make sure you have the right attorneys or the syndicate groups that often have their own attorneys, involved to make sure the structure is set up right. But simply speaking, under certain rules from the Internal Revenue Service, you can set up a structure whereby an investor member might become a partner in your real estate LLC and be allocated those federal credits. Now, as I mentioned, the federal credit has to be allocated in proportion to ownership. So oftentimes you'll see an investor member come in and maybe be allocated and maybe get 99% of your LLC interest. And so that they're allocated 99% of the credit. So there is a little heartburn at times. So a new developer that's now said, I had to give away 99% of my building to be able to allocate the credits to someone. So there has to make sure there's the right agreements in place, operating agreements in place, and other options in place to help unwind that entity at the end of a recapture period.
Yep. So let's say we have one of those outside investors. They've got ownership in our entity. Is there a process for getting that partner out of the partnership after a certain number of years after they've recaptured all those credits?
Yeah, there are, and the Internal Revenue Service back about 10 years ago now issued what's commonly known in the industry as the safe harbor. So we call it the safe harbor rules. It's under RevProc 2014-12, is where the guidelines on how all this works. And that's sort of the playbook, if you will, on how to structure these deals that will have an investor. So backing up, the state investor, again, you can have them in at a lower percentage, perhaps. The state credits can be allocated, and they don't have to be in proportion to ownership. However, the federal credits do. So there are some guardrails put up around the federal structure, so as at the end of 5 years or 60 months, which is the recapture period for the federal tax credit, there's usually a put option in place where the investor can then say, okay, I'd like to now be out of your entity. And so there's certain parameters that control how much that option needs to be, and that other criteria are met. That's probably beyond the scope of what we're getting into here today. But to answer the question, yes, there's absolutely ways for them to get out. And then usually the developers or the managing members of the entity will pay for them to go away, so to speak.
Understood. Yeah. I mean, so obviously, listeners out there, the complexity of this obviously warrants the fact that you need to have an architect who deals in this area, an attorney, accountants, obviously, because you have to have that audit completed in order to get approval. So be sure, if you're interested, listeners out there, if you're interested in these projects, make sure you're considering all these factors before you start jumping in by yourself into these projects. We're happy to help any way we can. Pat, I did want to back to the QRE conversation we were having. Have you ever seen where a project doesn't meet those requirements, where they're not spending over that adjusted basis amount?
Yeah, absolutely. It happens more often than I'd like, honestly. Especially if we've recently seen it, because of COVID, where construction had to stop at times. And so things got stretched out maybe longer than anticipated. So there might have been a bunch of money spent early on, but nothing got completed. And then they finished it years later. But it's hard to be able to piece together enough costs within either that 24 or 60-month measuring period we were talking about. So it's possible that you might not be able to find enough spend within those time periods to meet the hurdle. So it does happen. Most large commercial projects, not usually. Oftentimes, it's pretty easy to do. Especially if you're buying maybe a rundown building, that's going to be a low cost basis to you, or a low assessed value in the case of Virginia, that you're going to be able to hit those hurdles pretty easily. So it's rare, but it does happen, and it's happened more recently.
Very good. And if that happens, I guess you're kind of just out of luck if you don't meet those requirements, or what happens there?
Yeah, so either you need to spend more, or to your point, it's possible that you might be out of luck.
Yeah.
And there's different things you can do in the depending on whether it's a phased project or not. Again, you might have more time, but yeah, it is possible that there's just going to be no way without unnecessarily spending money that you may not be able to hit that mark.
Very good. Very good. Well, you kind of mentioned how construction slowed down during COVID. Obviously, that happened about 4 years ago. What are you seeing as far as the market, the appetite for these historic projects currently? Pretty active?
Very active.
Okay.
Yes, especially around Virginia, we're seeing a lot of projects going on. I think in this current market of higher interest rates and other increasing construction costs right now and everything else with that, these credits are extremely important to make a deal work. So if you didn't have the federal and Virginia and or whichever state you're in credit, the project just wouldn't make sense. Wouldn't be bankable, in other words. So you wouldn't be seeing a lot of these projects happening. Now with historic construction, at times the construction might cost more.
Mm-hmm.
There might be times where some of these older buildings, it could be easier to knock it down and rebuild, but the credits do really provide that incentive to not do that. So yeah, these credits are really making a lot of deals work that otherwise wouldn't.
Yep. Understood. It's good to point that out, that some of these tax strategies we discuss on the podcast, they can help make a deal work if the
Absolutely.
cash flow isn't there, if the interest rates are too high, if there's other factors. So this is just another way to kind of get over one of those hurdles. So
Yeah, and to everything we're talking about when we are involving, investors, that is oftentimes the cash coming back into your deal to pay down your construction loan or pay down the loan. So it makes it work.
Yep, definitely. Well, Pat, I appreciate you jumping on. Anything else you want to add to kind of this conversation and with historic rehab credits that may be important for listeners?
Yeah, just maybe a couple other. I know it's complicated to take this. There's so many moving parts with it and pieces to it. I would just add that Virginia's credit is 20% again of those QREs, and it is awarded all at once. So if it's $100,000 in Virginia credits, you're getting that $100,000 in the year that the project's placed in service. So on the federal side, there were some changes to the federal credit with the 2017 Tax Act. So the federal credits now, it's 20% credit, but it is now 4% a year for 5 years. So that really changed the way the federal program operates and the way that investors see the value in the credits too. So it has kind of changed the economics of some of these deals where you're getting 4% a year instead of 20% all up front. So that has changed the math a little bit on projects where you are bringing in an investor, but still a very valuable credit.
Very good. And do you mind just reiterating the carry forward and carry back rules for
Sure.
for the credits?
Yeah. So again, the federal credit's 4% a year. It will carry forward for 20 years. You can carry back 1 year on the federal side. On Virginia, it cannot be carried back, and it can be carried forward for 10. And neither of these is refundable. So you have to be able to use it against a liability.
Yep.
And again, when we probably one thing I should speak more to as well on that investor, we talked about you or I not being a real great candidate for those credits. What we see most often are larger corporations that do not have to deal with passive activity rules or at-risk rules at the individual taxpayers do. So oftentimes C corporations, taxed as regular C corporations, such as banks, oftentimes are the largest users of these credits. So they're very common. They're very commonly the investor in these projects. So a lot of times too, we'll see in smaller markets, some maybe the lender on a project might also be the investor. So it's a kind of a win-win for them in the community where they can be the lender on a deal as well as the investor on a deal, and they got money, so they're putting money in and it's coming right back to them.
Yep. Obviously, yeah. We definitely see that. Obviously, you and I have some involvement with the banking niche within our firm, and we see those investors sometimes with these historic tax credit projects.
Yep.
So,
and as you pointed out, I think very important to get your team of professionals in place really before you start the project, just to make sure all the ducks are in a row, so to speak. Your CPA, your attorney, your architect, most importantly at the beginning, and have that lined up.
Definitely. And if any of you listeners out there are interested and don't have an attorney, architect, syndicator of the credits potentially, let us know. We're happy to help with that. We have a lot of those connections within the community and throughout the state and country as well. So we're happy to help with that.
Yep. And our website, the IRS website, the Department of Historic Resources website, or the state SHPO websites are all great resources too for frequently asked questions as well on these types of projects. I know we kind of just hit the surface really on a lot of what's here, so it does get very complicated, and we can certainly talk to you at length and more detail about your specific project and your specific questions as it may vary.
Very good. Well, Pat, before we wrap up this episode, I know you shared your contact information in that first episode, intro episode. Do you mind sharing your email contact information one more time, just so if people do have questions, they can follow up directly with you?
Yeah, sure. My email is pmurtaugh, PMURTAUGH @becpas.com. That's brownedwardscpas.com. The phone number here at the office is 540-345-0936. And you can certainly find us on the website as well if you want to reach out there.
Definitely. Very good. Well, Pat, I appreciate it. A lot of good content today on these historic rehab tax credits. That is a wrap for this episode of the Real Estate Tax Playbook. As always, I appreciate everyone tuning in and listening. If you like what you're hearing, please make sure you subscribe if you have not already. Also, if there's additional content you want to hear more about as it relates to real estate, feel free to ping us and let us know what that content is. We're happy to add it to our calendar. Again, we look forward to bringing you another episode next month. Take care.